What if I told you that one of the most successful traders in history proved that anyone, a blackjack player, a security guard, even a Dungeons and Dragons game master, could be taught to make millions in the market? If you've ever wondered if great traders are born or made, you're asking the exact question that sparked a legendary bet between two trading titans. One believed success was a gift you were born with. The other was determined to prove him wrong, putting millions of his own dollars on the line to settle the debate once and for all. In this video, you'll learn the incredible story of the turtle traders, the exact rules they used to earn over $175 million, and the single psychological factor that separated the winners from the losers, even when they all had the same system. This is the story of Richard Dennis, the Prince of the Pit, and how he turned ordinary people into trading legends. Let's start with the man behind the myth. Richard Dennis wasn't born into privilege. He was a street kid from the south side of Chicago, growing up in the 1950s. There was no silver spoon, no wealthy parents, no connections. Just a kid with thick glasses and polyester pants who was fascinated by numbers. His first trade was a disaster. While still in high school, he bought 10 shares of a $3 phonograph stock. The company went bankrupt, but that failure didn't discourage him. Instead, it taught him his first lesson. The market doesn't care about your hopes. What Dennis did have was an intuitive understanding of odds. He was a natural at poker, understanding that winning wasn't about any single hand. It was about playing the probabilities over hundreds of hands. This insight would later become the foundation of his entire trading philosophy. At 17, Dennis landed a summer job as a runner on the Chicago Mercantile Exchange, earning $1.60 an hour. Every day, he watched traders screaming and fighting in the pits, making and losing fortunes. He was hooked. But there was a problem. You had to be 21 to trade. Dennis found a workaround. He convinced his father, a blue-collar city worker who hated the markets, to act as his proxy. The father would stand in the pit while young Richard signaled trades from the sidelines. It was unconventional, but it worked. Dennis went to college at DePaul University, where he fell in love with philosophy. He was particularly drawn to the British empiricists, David Hume and John Locke. Their core belief was simple: knowledge comes from experience and observation, not from faith or tradition. This became his worldview. Dennis applied empiricism to trading. He didn't care what the experts said. He didn't care about market predictions or analyst opinions. He cared about what the data showed. If a strategy worked historically, he would use it. If it didn't, he would discard it. No ego, no attachment, just evidence. By the time he was 24, Dennis had turned a borrowed stake of $1,600 into $100,000. By his mid-30s, that had grown to over $200 million. He became known as the Prince of the Pit, one of the most successful commodity traders in history. His partner was William Eckhardt, a brilliant mathematician and equally successful trader. They were close friends, but they had a fundamental disagreement. Dennis believed trading success was a skill that could be taught. Eckhardt believed it was an innate talent. You either had it or you didn't. The argument went on for years. Finally, Dennis proposed a bet. He would recruit a group of complete novices, teach them his exact trading rules, give them his own money to trade, and prove that anyone could be trained to succeed. Eckhardt accepted the challenge. Dennis had recently visited a turtle farm in Singapore, where they raised turtles quickly and efficiently. He told Eckhardt, "We're going to grow traders just like they grow turtles in Singapore." And so, the turtle traders were born. In 1983, Dennis and Eckhardt placed ads in the Wall Street Journal, Barron's, and the New York Times. They were looking for people willing to be trained as traders. The response was overwhelming. Over 1,000 people applied for just a handful of spots. The selection process was unusual. Applicants had to answer a series of true or false questions designed to test their understanding of risk and probability. One question asked, "The big money in trading is made when one can get long at lows after a big downtrend." The correct answer was false. The final group was deliberately diverse. There was a professional blackjack player, an Air Force pilot, an accountant, a security guard, and a Dungeons and Dragons game designer. Dennis didn't want people with trading experience. He wanted blank slates, people who would follow the rules without preconceived notions. The training lasted just 2 weeks. Dennis and Eckhardt taught them a complete mechanical trading system. There was no room for interpretation, no gut feelings allowed. Every decision, when to enter, when to exit, how much to risk, was governed by explicit rules. The philosophy was simple: trade with the trend. Dennis believed that markets trend, and that the big money is made by riding those trends. The system was designed to catch major moves and ignore the noise. It was trend following in its purest form. The turtles were taught 2 systems. System 1 was a short-term breakout system. You would buy when the price made a new 20-day high and sell short when it made a new 20-day low. The idea was to catch emerging trends early. System 2 was a longer-term system. You would enter on a 55-day breakout, a new 55-day high for longs, a new 55-day low for shorts. This system was designed to catch the major, secular trends that could last for months or even years. Getting in was the easy part. The exit rules were just as important. For System 1, you would exit a long position when the price hit a 10-day low. For System 2, you would exit at a 20-day low. This ensured you would let your winners run while cutting your losses short. Think about what this means. If you buy at a 20-day high and the market keeps going up, you stay in. You only exit when the trend clearly reverses. This means you might give back some profit at the end, but you capture the majority of every major move. But the most important rule wasn't about entries or exits. It was about position sizing. Dennis taught the turtles a revolutionary concept: size your positions based on market volatility. This was the true secret weapon. Dennis called it N. N was the average true range, a measure of how much a market typically moved in a day. Every trade was sized so that a 1N move against them would cost no more than 1% of their total account. This meant they would take smaller positions in volatile markets like crude oil and larger positions in quieter markets like corn. The risk per trade was always the same in dollar terms, regardless of the market. It was elegant, mathematical, and effective. There was also a hard limit. Never risk more than 2% of your account on any single trade. This ensured that no single loss could devastate the portfolio. It was a rule designed for survival. After the 2-week training, Dennis gave each turtle a trading account funded with his own money. The amounts ranged from $500,000 to $2 million. These were complete novices, and they were now managing millions. The pressure was immense. The results were almost immediate. The turtles started making money. Not all of them, and not all the time, but as a group, they were profitable. The system worked. Dennis's hypothesis was being validated in real time. Over the next 5 years, the 2 classes of turtles that Dennis trained earned an aggregate of over $175 million. Some estimates put the total even higher. It was one of the most successful trading experiments in history. The most successful turtle was Jerry Parker. He would go on to found Chesapeake Capital, one of the largest managed futures firms in the world, managing billions of dollars. He proved that the turtle principles could scale to institutional levels. But here's where the story gets truly interesting. All the turtles were given the exact same rules. They sat in the same room, learned the same system, and traded the same markets. Yet their results varied wildly. Some made fortunes, others barely broke even. A few even lost money. If the system was the same, why were the results different? The answer is the most important lesson of the entire turtle experiment: psychology. The difference between the winners and the losers wasn't the system, it was their ability to follow it. Trend following is psychologically brutal. Most of the time, markets don't trend. They chop around in ranges. This means a trend-following system generates a large number of small, losing trades, punctuated by occasional massive winners. The turtle system had a win rate of only about 40 to 50%. That means more than half of all trades were losers. For most people, this is emotionally devastating. We're wired to want to be right. Losing more often than you win feels like failure. The real test came during drawdowns, those painful periods when your equity slowly bleeds away, loss after loss. Some drawdowns lasted for months. The turtles who couldn't handle this emotional pain started to break the rules. They would skip a signal, hoping to avoid another loss. They would take profits early, afraid to give back gains. They would add to losing positions, hoping for a reversal. Every deviation from the rules was a step toward failure. And here's the cruel irony. The signal you skip is almost always the one that would have made you rich. The turtles who deviated from the system missed the big trends. The ones who followed the rules mechanically caught them. Richard Dennis understood this. He designed the rules to be mechanical precisely because he knew that human judgment under pressure is unreliable. The discipline to follow the rules was itself the edge. Without it, the system was worthless. As Dennis himself said, the key to trading success is emotional discipline. If intelligence were the key, there would be a lot more people making money trading. It wasn't about being smart. It was about being consistent. So what did the turtle experiment prove? It proved that trading can be taught. The nurture side of the debate was validated, but it also revealed the limits of teaching. You can give someone a perfect system, but you can't give them the discipline to follow it. The final variable was always the trader's inner game, their ability to manage fear, greed, and the pain of losses. This is the part that can't be taught in a 2-week seminar. It has to be developed through experience, self-awareness, and relentless practice. What does this mean for us today? The markets have changed since the 1980s. The specific parameters of the turtle system may no longer be optimal, but the principles are timeless. First, have a system. Don't trade on gut feeling or tips from friends. Develop a set of rules that have been tested and validated. Know your edge. Second, manage your risk. Position sizing is not an afterthought, it's the foundation. Never risk so much on a single trade that a loss could knock you out of the game. Third, let your winners run and cut your losses short. This is the hardest thing for most traders to do. We want to take profits quickly and avoid the pain of realizing losses. The turtle system was designed to force the opposite behavior. Fourth, follow your rules. Every time you deviate, you're introducing randomness into your results. You're no longer trading a system, you're gambling. Think of it like a casino. The casino doesn't win every hand of blackjack, but they have an edge, and they execute that edge consistently, thousands of times. Over time, the math works in their favor. The turtles were taught to be the casino, not the gambler. But being the casino has an emotional cost. You have to watch yourself lose, over and over, knowing that the wins will come eventually. You have to trust the process when every instinct is screaming at you to stop. This is the price of success. The turtles who succeeded were the ones who could pay this price. They had the emotional resilience to endure the drawdowns. They had the discipline to execute the signals without question. They trusted the system more than they trusted their feelings. The turtles who failed were often the smartest ones. They thought they could improve on the system. They thought they knew better. Their intelligence became their enemy, leading them to override the rules at exactly the wrong moments. There's a lesson here about humility. The market is smarter than any individual. The best traders are the ones who accept this, who subordinate their ego to the system, who execute with mechanical precision. Richard Dennis eventually stepped back from active trading. He had proven his point. He had made his fortune, but his legacy lives on in the traders he trained and the principles he codified. In 1993, the original turtle trading rules were released to the public. Anyone can now access the exact system that made millions. And yet, most people who try to trade it fail. Why? Because they can't follow the rules. The rules are the easy part. They can be written on a single page. The hard part is the execution. The hard part is the psychology. The hard part is being a turtle when every fiber of your being wants to be something else. So here's your challenge. Don't just learn the rules, learn to follow them. Develop the emotional discipline that separates the winners from the losers. Become the trader that Richard Dennis proved you could be. Dennis won his bet with Eckhardt. He proved that traders could be grown like turtles in Singapore. But he also revealed a deeper truth. The system is only half the battle. The other half is you. The turtle experiment is more than a trading story. It's a story about human potential and human limitation. It's proof that with the right system and the right mindset, ordinary people can achieve extraordinary results. The question is, will you be one of them?